There's a feeling you get when standing at the summit of a mountain. Thin air, dizzying views, the illusion of invincibility. But the higher you climb, the more fragile the silence becomes. Welcome to FluxFolio Finance. Today, we stand atop the financial peaks of 2025. The S&P 500 has shattered old ceilings. The Nasdaq glows with the fever of AI-fueled dreams. Across the Atlantic, the FTSE 100 and DAX march upward in step, echoing the same mantra. This time is different. But is it? Or are we merely admiring the view from the edge of a bubble, thin-walled, glistening, and doomed to burst with the next tremor? Let's begin with the numbers. They don't lie, but they often flatter. As of mid-June 2025, the Nasdaq is up over 28% year-to-date. The S&P 500 up 19%. Apple, Nvidia, and Meta now make up a larger share of the S&P than any three firms in history. Even the staid FTSE 100 is flirting with all-time highs, buoyed by a weaker pound and a rebound in commodity stocks. On paper, it's a golden age. Earnings have been resilient. Inflation, while sticky in places, is no longer the villain it once was. Central banks whisper sweet nothings, rate cuts soon, soft landings, resilience, and markets, ever the romantic, swoon in response. But zoom in closer and the gloss fades, because beneath the surface lies the quiet machinery of distortion, of cheap capital, algorithmic momentum, and wishful thinking. Start with the Federal Reserve. While it has paused its rate hikes, it hasn't cut. Not yet. Core inflation remains above target. Labor market data is noisy, distorted by post-pandemic migrations, immigration policy whiplash, and shadow gig economies. And with Treasury yields near 4.6% on the 10-year, the cost of capital remains historically high. Then there's Europe, where the ECB prepares for its first rate cut in this cycle, a move more rooted in desperation than strength. Growth has stalled. Germany teeters on recession. And yet, markets climb. Why? Because liquidity is a seductress and hope a powerful drug. Fiscal stimulus across the US, UK, and EU, green energy projects, tech subsidies, military budgets have created a sugar high. Investors, giddy from the last AI earnings report, are ignoring fundamentals in favor of narrative. Nvidia doubles in 6 months? Of course, AI will reshape everything. Meta buys into scale AI for $15 billion. Naturally, data is the new oil. Tesla pivots to humanoid robots? Why not? The future is frictionless. But the faster this future arrives in valuations, the more fragile the present becomes. Take a look at the Buffett indicator, the ratio of market cap to GDP. It's near 180%, levels unseen since the dot-com peak. And Warren Buffett himself, he isn't buying, he's hoarding. Berkshire Hathaway sits on more than $347 billion in cash, its highest war chest ever. It's not because there are no good companies, it's because there are no good prices. In 1999, the world believed in a new economy, dot-coms, eyeballs, clicks per user. In 2007, it believed in infinite leverage, mortgage alchemy, and the gospel of home ownership. And in 2025, the gospel is AI. But behind the screen of machine learning models and predictive graphs lies an economy still burdened by debt, deglobalization, and fragile trust. Let's not forget the ghosts still dancing in the data. America's national debt is over $36 trillion. Moody's downgrade in May shook the myth of invincibility. The US must refinance $7.6 trillion this year alone. That's not just a number. It's a match waiting for oxygen. And here's the paradox. The higher stocks climb, the tighter the noose becomes around real yield spreads, pension fund allocations, and insurance firm risk models. When asset prices soar far above economic growth, Rebalancing isn't a theory, it's a requirement. And when rebalancing begins, it doesn't whisper, it crashes. We saw hints of it in early April. Treasury yields rose 23 basis points in one day. ETF flows reversed. A $200 million net inflow into AI-heavy funds flipped into a $700 million outflow within 72 hours. Momentum died. Stops were triggered. The machines reacted. It was fast, mechanical, indifferent. That's the danger of this new market. It doesn't believe. It calculates. It doesn't care about innovation. It cares about volatility buckets and sharp ratios. So when you hear someone say, everyone's buying AI, understand, they're not buying the future. They're buying exposure. And exposure can vanish with one quarterly earnings miss. But perhaps the most ominous sign is how risk has gone silent. The VIX, Wall Street's fear index, is near historic lows. Credit spreads are tight. Junk bond issuance is booming again. Risk, it seems, has been priced out of existence. But risk is not a number. It is a rhythm. And when markets stop listening, risk waits in silence until it doesn't. Now let's explore the lessons from past bubbles, the signals that precede a fall, and the emerging fractures already showing in global credit, crypto leverage, and sovereign liquidity. Because before every fall, there is euphoria. And euphoria in markets is not joy, it is blindness. Every market bubble is a mirror. And in that mirror, we see more than charts. We see belief, unquestioned, universal, unshakable, until the first crack appears. To understand the present, we must first revisit the past. Because history doesn't repeat, but it rhymes in sickeningly familiar chords. In 1999, dot-coms promised digital utopia. Eyeballs were revenue. Clicks were gold. And the Nasdaq soared to the heavens on the wings of dreams. But dreams are delicate things. When Pets.com collapsed, it wasn't just a sock puppet that died. It was an idea. That growth could replace earnings. That technology could erase risk. That money, when made virtual, no longer obeyed gravity. In 2008, we danced a different dance. This time, the music was real estate, mortgage bonds, CDOs, the illusion of safety dressed in AAA robes. But safety, true safety, cannot be manufactured. When Lehman fell, it wasn't the bank that mattered. It was the contagion of trust, the recognition that leverage is not wealth, that borrowing tomorrow to buy today is not a strategy, it is a time bomb. And now, in 2025, we flirt once more with the mirage. This time, it's not eyeballs or houses. It's algorithms, neural nets, generative AI whispering answers to every question. Companies with no earnings, just transformational potential. Investors no longer read balance sheets, they read roadmaps. And as Nvidia crosses the $6 trillion valuation mark, as venture firms offer term sheets before seeing a prototype, we must ask, is this vision or is this hypnosis? Because bubbles are not built from fraud, they're built from faith. But while faith inflates the balloon, leverage pins the tail. Let's talk basis trades. As of mid-2025, over $1.1 trillion sits in institutional strategies that exploit price gaps between Treasury futures and the actual bonds. Hedge funds borrow short to buy long, profiting from arbitrage that seems safe until spreads widen. It's the same playbook used before the 2008 collapse, only this time it's bigger, faster, and more algorithmically precise. When Treasury yields spiked after Moody's downgrade, those trades trembled. Margin calls loomed. And should rates rise just 50 basis points more, we could see forced unwinds that dwarf the Archegos or LTCM debacles. And it's not just bonds. In crypto markets, leverage has returned with a vengeance. Ethereum Layer 2s offering 50x margin. Bitcoin ETFs seeing inflows not from belief, but from models dictating allocate 3% to digital assets. When these models change, when volatility spikes, redemptions cascade, and Bitcoin becomes not a store of value but a fire sale. Meanwhile, sovereign debt, once the ballast of portfolios, is becoming the risk. In 2025, over $7.6 trillion in U.S. Treasuries must be rolled over. The ECB cuts while the Fed holds. Japan flirts with exiting yield curve control. And emerging markets? They watch the U.S. with wary eyes, knowing that if the dollar spikes, their debt becomes unpayable. Liquidity is no longer guaranteed. And in finance, illiquidity is death. So what should we watch? Watch the bond market. It is the fault line. When 10-year yields move 20 basis points in a day, it's not a signal. It's a scream. Watch the repo market. If overnight rates spike, the machine is breaking. Watch ETF flows. The moment they reverse, they do so fast and without mercy. But don't just watch. Prepare. Because markets don't crash when people panic. They crash when people believe they're safe. So how do you survive? Start here. Hold liquidity, but not just in cash, in conviction. Cash can be devalued, but conviction, well-placed, reasoned, grounded, is your true asset. Diversify across systems, not just sectors. Don't just buy tech, energy, and healthcare. Own different rulebooks. Gold, Bitcoin, hard assets, intellectual capital. Even geographical exposure matters now. Beware of leverage dressed as strategy. Many ETFs today use synthetic exposure. Many funds use swap chains that look like hedges, but behave like leverage. Read the footnotes. Watch the crowd and stand where it isn't. In bubbles, value hides in the unsexy. Railroads in 2000. Energy in 2021. Today, perhaps it's clean water, precision farming, trustless systems, anti-hype assets. And most of all, remember that the market is not your friend. It does not care about your timeline, your dreams, your retirement. It is a machine of extraction. And its first rule is reward belief, then punish it. Because every boom ends not with a bang, but with a whisper, a single headline, a missed earnings report, a yield spike, and the balloon, stretched too thin, vanishes. So where do we go from here? We live in a bifurcated world. On one side, infinite optimism, digital empires, and synthetic liquidity. On the other, rising debt, geopolitical fracture, and monetary erosion. Markets today are priced for perfection, but perfection is rare, and volatility, like gravity, always returns. So, whether this is the top of a new paradigm or the last gasp of an old one, will not be determined by headlines. It will be determined by action. Your action. Hold your curiosity. Question the consensus. Track the tremors. Because the mountain may look beautiful in the sun, but when the storm rolls in, only those who saw the shadows will find shelter. Thank you for watching FluxFolio Finance. Like, subscribe, and drop your thoughts in the comments. Do you believe we're in a true new era or on borrowed time? Until next time, stay sharp, stay grounded, and above all, stay ahead.